We've just had some of our worst days on markets in recent memory, and today we're going to unpack the question of if there may be a bigger storm up ahead. Investors, analysts, economists continue to battle over this discussion. No matter which side of the coin you sit, ultra bearish or ultra bullish, there is no way to deny there's significant fear, uncertainty, and doubt throughout the markets wherever you look. Today, we've brought together a range of different data sources from both sides of the aisle, and we're going to come together and have this discussion and try and unpack where things may head from here.
Welcome to the channel and enjoy.
And so let's get into it. As mentioned, we've got a range of different data sources and insights to work through together as we unpack this question of whether there is this bigger market storm ahead. It's going to be a fascinating video, so I hope you enjoy it. But starting off with this first one, it's courtesy of Jamie Dimon. He is the CEO of JP Morgan, one of the world's largest investment banks, and he stated, "Brace yourself for an economic hurricane." Caused particularly, he's attributed it to the Federal Reserve and the Ukrainian situation. He said that there's two main factors that's worrying: the QT, which will be commencing from June the 1st, unwinding that up to $9 trillion balance sheet that the Federal Reserve has expanded to. And the other factor is, of course, the Ukrainian situation and its effect on commodities. What's worth noting as well here is some of the commentary surrounding it. He said there was previously storm clouds, but he's going to change it. It's a hurricane. Conditions may seem fine at the moment, Jamie Dimon said, but he said the hurricane could potentially be just a minor one, or a superstorm Sandy. Of course, this is from a very renowned person within the financial sector, and so it did make the market sit up and pay attention, particularly as he's given some information surrounding JP Morgan bracing themselves and going to aim to be very conservative with their balance sheet. This was then followed on and added on to by the Goldman Sachs president, who warned of unprecedented economic shocks and tougher times ahead. So as we can see here, Jamie Dimon obviously provided the initial insight, and then John Waldron, the GS president and chief operating officer, stated, "This is among, if not the most complex and dynamic environment that he's ever seen in his career." Obviously, he's a leading executive, so when you're hearing from both Goldman Sachs and JP Morgan within the same week, it makes a lot of people sit up. He stated, "We've been through a lot of cycles. There's a confluence of shocks to the system. It seems unprecedented. They anticipate that there's going to be tougher economic times ahead. No question that they're seeing a tougher capital markets environment. Several alarming factors, including the commodity shock and unprecedented amount of monetary and fiscal stimulus." This builds on top of Tesla's Elon Musk stating he had a super bad feeling about the economy. Don't worry, we'll be talking about Elon Musk and some of the tech layoffs later in the video. But just these two to kickstart us off, of course, sent a few shockwaves throughout the system. However, it is worth being balanced and sitting on both sides of the coin. And as we saw here, JP Morgan stars actually took the other side of Dimon's hurricane trade. So as we know, these global investment banks, they're not just individual people. They have a range of different teams and views within them. And so we saw a few of these coming out. Marko Kolanovic, who's well renowned as one of the leading equity strategists in the world, he actually stated on the same day that Jamie Dimon discussed that hurricane that we talked about, he stated that in their view, there will be no recession given supports from the US consumers. And we have seen the US consumers be relatively resilient throughout. We know household savings rates are still relatively high, though of course they're starting to be churned into with negative real wages. But then less than a week after that, the chief economist Bruce Kasman told Bloomberg that the strength of the household and corporate finances would keep the economy buoyant. They don't see a financial storm coming right now. They believe as their base case that the economy is going to avoid recession as they go through the rest of this year. I just always think that it's worth noting that there's always two sides to every story, to of course take in a range of different information and insights. And then what you want to be doing is informing your own worldview, because everyone's got different insights based on their assumptions and the way that they're looking at the data and everything that's out there. In terms of where we're positioned, the VIX back above that 30 mark. But the question now that's been coming through is 40 going to be the new 30? We know that over the longer run or the longer run time, that 30 mark has essentially signified a capitulation or significant sell-off or a washout. If you think back to the back end of 2018, we saw that washout happen. This basically signified in and around the bottoms around this month period there. Of course, the March 2020 period was atypical. But if you look through here, we've seen that 30 has been a relative sign of resistance to the north side there. We've now got a home here above that 32 level. So we'll see what happens to the VIX. If we see a washout type event, maybe it spikes to 40. But of course, as volatility rises, as we've started to see over this past period, there's a range of different flow and implications to the markets. It is worth noting that the driver of this recent volatility spike was US inflation. We've obviously talked about it on the channel previously. There was the aim or the aspirations that potentially we might have seen peak inflation. A couple of months ago, we saw that 8.5% read. Then it retraced back down to the 8.3%. But then unfortunately this month was 8.6%. We saw significant uplifts across the areas. Energy, 34%. Food was up by 10%. Of course, all items less food and energy, this is your core inflation levels, was at 6% there. And so this hotter than anticipated read for inflation tied into the thesis that potentially we're going to see the central banks, particularly the Federal Reserve, but central banks around the world have to move faster and quicker to try and tame this inflation. And obviously the risks that could have for a soft landing and potentially sending the economy into a recession. We've seen the money market start to price in a 75 basis point rise now at this upcoming Federal Reserve meeting. Previously, the base case was 50 basis points, but obviously there's some discussions around that. But then on the other side of the coin as well, because we're looking at both sides today, is this really interesting article from Bloomberg that came out recently about potentially indications about the fact that inflation may be poised to ease. It's a long article. I'll let you read it in your own time. But having a look here at kind of some of these visuals that were kind of the cornerstone of the article itself. They looked at some indexes, which gave some indications about the computing space, the semiconductor space, shipping, obviously to give that insight into the broader logistics space, and then fertilizers, obviously as an insight into the agricultural trends moving forward. And as we can see here, we started to see a peak towards the back end of the year, but a natural subsiding at the index level for many of these, particularly through towards the middle of the year. We know that all of the central banks have been providing that commentary that they're anticipating this easing towards the back end of 2022. Of course, as they're trying to curtail demand as well with their monetary policy and the raising of interest rates, but they're hoping that the supply side pressures, a lot of which have been on the commodities and other areas, will start to subside. So this was an interesting article just to see that across your logistics, semiconductors, obviously with the chip shortage being a key driver there, and then agriculture. We did see Elon Musk come out and state he has that super bad feeling about the economy, needs to cut about 10% of salaried staff. It's worth noting he did seem to walk this statement back after it, but this initial statement did cause a little bit of an alarm, particularly as it may serve as a canary in the coal mine for the broader EV space and the growthier end of the market as well. But what is worth noting is, regardless of the current stance of Tesla, there have been layoffs quite significantly across the technology space. Obviously, the technology space has been the growthier end of the market, where there's been a lot of potential excess, a lot of spending just to growth. We know that the market was prioritizing growth over this past period, but now it's much more focused on cash flows in the current term. But if we look at just some of the names recently, Coinbase came out overnight. Stitch Fix was a recent one as well. Having a look further down here as well, we can see a range of different companies. There was Netflix, there was PayPal, there was Skills, there was Vroom as well. There was obviously Twitter, has Robinhood. And so there's just a lot of these mega cap technology names. The buy now, pay later companies have been similar as well, including Sezzle, as you can see here, Peloton. So a lot of the winners from the past period have had to start to pull back on their workforce. And so it'll be fascinating to see if these trends continue, and also what it will mean for the broader market, because obviously it's been more so concentrated in the tech area, but if it does start to flow through into the rest of the economy as well. Because at the moment we do know we've got this tight labor market across the world with record, 40-year plus record low employment in many jurisdictions. So it'll be interesting to see how that flows through. And then Cathie Wood, she's always in the news, always in the discussion. It is worth noting that this was before the recent inflation print, but Cathie Wood stated that the massive inventories held by US companies suggest that inflation will die down. She's never seen inventory surges like this in her career. She's been around it a long time. This inventory issue highlights a cyclical reason that they've been saying that they think inflation will unravel. We saw a really interesting print, or really interesting outlook revision from Target, which cut their profit outlook for the second time in under a month. Obviously shows difficulties forecasting and lack of visibility across that, just in terms of the consumption demands, because there was obviously a lot of spending throughout the atypical period in 2020, 2021, but now just trying to navigate this transition, particularly as consumption moves from more goods focused towards service based, which is some trends that we're starting to see. So this was an interesting discussion from Cathie Wood. She's obviously very bullish on the growth and the opportunity for innovation to disrupt many conventional industries. But interesting to read that. And it is worth noting as well, we've seen the 2-10 spread come in and quite significantly. We know that obviously the 2-10 spread particularly is looked at as an important one. If yield curve inverts, it's often seen as a potential risk of as a leading indicator of a recession. We saw that inversion a couple of months ago, but we've seen the basis point spread come in as close as 3 or 4 bips. So it'll be fascinating to see what happens, as obviously it's an indication that of the market's anticipation about what the Federal Reserve and other central banks will have to do over this upcoming period to curtail inflation, but also what that could mean for growth as well on the other side of the coin. Everything's pointing towards this upcoming Federal Reserve meeting. There's not long to go. This is going to be an important decision, but obviously it's only just one of a series of decisions that's really going to paint the picture and really tell the tale of where markets will be heading from here moving forward. There are still risks weighted towards the downside. It's going to be a fascinating one, however. And so, where does that leave us? First and foremost, we've officially launched the second channel. It's now live. Head on over, subscribe, turn your bell notifications on. We'd love to have you join and support us over there. But there's a range of different factors to consider. Of course, right on the horizon is this Federal Reserve rate decision. Is it going to be 50 basis points? The market's now pricing in 75 basis points. Potentially, could there be a shock of 100 bips? There's a lot of uncertainty there, but not only the trajectory of the rate hike, but also the wording and commentary surrounding it. It's going to be important to see how the markets can digest that and settle it. Of course, inflation prints. All of them are going to be important from here on out. So we'll continue to watch for the data and to see what that shows, and particularly if we see that natural subsiding of inflation towards the back half of this year. Of course, consumption, the risk of the soft landing potentially missing, and maybe we start to see a more significant growth slowdown. All of these are uncertainties that we're going to continue to watch for. But one way or another, it definitely looks like the second half of 2022 is going to be shaping up to be an uncertain one, but it's going to be a story worth watching. Thank you for joining us. Drop in a comment letting us know your thoughts. For now, stay well and happy investing.